Hi everyone. So we're going to talk today about the concept of VaR, which is the short form for value at risk. So the value at risk basically is one of the common measures to measure the market risk in a portfolio, which typically talks about risk to traded positions. Let's say you own a portfolio at time t0 with an investment value of V naught. With time, the value of the portfolio will change. Let's build a scenario where it changes to V1, V2, and Vn across time. Now, when we talk of market risk, and let's say you've invested into this portfolio, what you're basically interested in is measuring the value of the portfolio at various points in time against your initial investment. So your P&L at a particular point of time will be T1, for example, will be V1 minus V0, V2 minus V0, and so on, Vn minus V0. For simplification, we are ignoring the time value of money here. Now, when we talk of risk, what we are typically interested in is what are those scenarios or situations under which this value will be positive, i.e., or rather negative, i.e., V1 is less than V0. That's when you will make a loss. And this kind of is reflected sometimes using this notation of V1 minus V0 being with a negative sign here, meaning that you only take V1 minus V0 when it is negative. That's the only quantity that you're interested in when you're trying to measure your market risk. Um, Now, obviously, this value can change over time. And what you will be bothered about is, in this case, for example, Vn minus V0, negative side of it. Now, just to make a diagrammatic representation of this, let's say this x-axis is the time, and here you have the value at time t. You start off at V0 at time t0, and the value of the contract is, let's say, changing over time. Let's say this is point t1, then you have point t2, t3, and so on. At time t1, under this path of the value of the portfolio, we see that V1 is higher than V0, i.e., under this situation, we will not be making a loss. However, we know that the value of the portfolio can be dependent on various factors. Maybe it's a product which is dependent on interest rates. So the value is dependent on interest rates. So under one scenario, you get this value of the portfolio based on your underlying valuation approach. Under any other interest rate scenario, it could take a different path. For example, this could be another path. This could be another path. This could be another path. So when we talk of market risk, what we are interested in is those paths which will lead to a value which is less than the initial investment value, which is effectively parts of the curve which are below V naught. So over time, the valuation of the contract is changing at any given point of time as well. We can simulate different values of the portfolio under different assumptions. In this case, risk driver being interest rates. Under different interest rate scenarios, you could have different simulations of the value of the portfolio. Now, what you're interested in is under a certain level of confidence to make a statement that how much is the loss that I could expect to make. And for that, maybe it's easier to kind of tilt this graph from the vertical to the horizontal axis and represent it this way. So you take a particular slice of time t1. So this entire graph is for vt1 or v1 minus v0. at T1. So what you will effectively see is that the loss can look like this, a distribution like this. We try to measure V naught minus V1 because we are interested in the negative side. So I just flipped this to V naught minus V1. And you say this slice, the different points in this slice are these points. So on average, let's say if this is the loss you are expecting, then this translates into the mean loss here, into this point here. So effectively what we are saying is if on average you expect to lose this much, right, at this, let's say V1M as a mean, then this value is V0 minus V1M. This is the loss you will expect to make on average. And typically for a risk measure, you're not just interested in the average loss that you expect to make, but you're interested in simulating extreme situations. So what you're typically interested in is not taking the average, but rather a very high percentile of the distribution. So let's say 99 percentile. And you say, what is the value of this V naught minus V1 at this very high percentile? That becomes actually the VaR. So what VaR at time t1 with a 99 percentile or 99 percentage confidence says is that for a for a fair bit of probably for a fair bit of the distribution of the losses, you would expect to make losses which are lower than this level. So this is the VaR level. If let's say you have a portfolio of 10 million and your VaR at 99 percentile is 1 million, which means this value is 1 million, you would say that for 99% of the times you would expect to receive or make losses which are lower than this level. What it does not, however, say is that if you end up being in a rare event which is on the right side of this, which is here, your losses may be much higher than this 1 million because the value of V naught minus V1 can be a very large value. This can have a very large tail. But 99% of the times you would expect that at time t1, your loss will be less than this 1 million. And this 1 million in this case is the value at risk. So that's, friends, a short introduction to the concept of VaR. Thank you.